Hi and welcome everybody. In this video, we will be going over 4 ways to identify a wonderful company to invest in. Notice how I said wonderful. What do I mean by this? What I mean is that we are going to be looking for the company that knows how to make money, is good at making money, and will continue to make more and more money for the next 50 years. So sit back and enjoy the video. For people who are new here, our focus of discussion will be on companies which are on the stock market. One of the first factors to consider when looking for a fantastic company to buy is to recognize its earnings. A lot of companies in the stock market are not profitable, and who wants to own a company that doesn't make any money? Once we have identified the profitable companies, we must go through a series of checklists to ensure that we have found the wonderful few. Don't be surprised if only a few of the companies you have found are profitable. Once you have found the profitable companies, add them to a watch list on Yahoo or Google Finance. There you can make an account and keep track of your portfolio of stocks on your different devices. These are both free services. They do not require any payment information. The second step of the search process is to ensure that the company has a wide moat. A moat is a deep, wide ditch surrounding a castle, fort, or town, typically filled with water and intended as a defense against attack. In economics, a wide moat refers to a company that has something unique compared to its competitors, and therefore has some sort of business advantage. This can be something like multiple patents, multiple revenue streams, a recognized brand, strong customer loyalty, or a unique product or service. The third step to identifying a wonderful company is to ensure that it can grow, and has been growing for the previous 5 to 10 years. To do this, we can simply look at a few key metrics dating back to as far as we can find. 1. Increasing revenue growth. 2. Increasing expenses, relatively in line with the revenue growth. 3. Increasing earnings. 4. Increasing dividend payments. 5. Share repurchases during times of economic expansion and contraction. 6. Cash on hand that can be used for future investment. A minimum of 10% to market capital is ideal. 7. The amount of debt carried by the company. At most 40% of the total market capitalization. We can begin our search through various means. 1. By reading through the company 10K statements. These can be found on the very bottom of the company's website under subheading, Investor Relations. This method is more accurate as it is considered a primary source of information. The negatives to this approach are that it is too time consuming and not very easy to interpret when comparing multiple years of financial data to one another. The second approach is to use online services, such as those supplied by brokers. A few examples are TD Waterhouse and YCharts. 3. The last option is to use a free service such as macrotrends.net, Yahoo Finance, or Google Finance. The fourth and final step is to evaluate the company and buy it at a bargain deal. This means calculating the fair market value for the stock and paying less than that. When we pay less than the real value of a stock, we are guaranteed a margin safety, which is always to the investor's advantage. Here is a question for you. If the 10-year bond is yielding 2%, how much should a stock yield? Calculating the yield of a stock is done by dividing the earnings of the last year by the current stock price. If a company has earnings per share of $10 and the stock price is trading at $100, then the earnings yield can be calculated by dividing $10 by $100, followed by multiplying again by 100 to get a result as a percentage. The earnings yield in this case would be 10%. This can be looked at as a price to earnings ratio where the price of the stock is $100 and earnings is $10. Dividing the stock price by earnings would result in a price to earnings ratio of 10, otherwise known as a PE ratio of 10. According to market conditions today, stocks yield anywhere from a negative percentage to roughly 30%. Our goal as investors is to minimize our risk. Thus, if we can get an investment of 2% risk-free, in this case, an AAA government bonds, why would we invest in a stock that only yields 2%? With today's monetary policy, aka interest rates, At century lows of near 0%, a cautious investor would accommodate for at least 5% margin of safety. So if a 10-year government bond is yielding 2%, the minimum return required in a stock investment should yield at least 7%. This margin of safety accounts for possible future hikes in interest rates. Keep in mind that this is the absolute minimum for the investor, and that we are looking for deals which can optimally yield more. In summary, 1. Make sure the company is profitable. 2. Ensure that it has a wide moat. 3. Company has met all primary requirements. 4. Purchase the issue at a bargain price with an adequate margin of safety. Smash the like button if you enjoyed the video, and let us know if you have any questions in the comments below.